I would also say that on mutual funds, anybody wanting to invest in funds, please tone down your return expectations to 10 to 12%. I get inquiries saying I need to make 18 to 20% out of my mutual fund. So, these are some of the things that people need to be cautious about.
The Sound of Money with Santosh Sirur.
Hello and welcome to another super special episode of The Sound of Money with me, Santosh Sirur. Today I have a very special guest joining in from Bangalore. She's Mrin Agarwal, very familiar face on business television. Hi, Mrin, and welcome to the Sound of Money podcast.
Thank you, Santosh.
Most welcome. So Mrin is the director of Finsafe, and she's also the co-founder of Womantra. She's also a SEBI advisory committee member, and that's for the IPEF, which is all to do with the investor protection. So let's catch up with Mrin on a varied issues, and today's topic very specifically deals with how about managing one's personal finance. So personal question and personal finance, I think that's something which really go together. So Mrin, my first question to you is, when you talk of personal finance, there's a very regular term that is used, which is all about personal or financial well-being. What does that really comprise of?
Right. So there are financial well-being is really a state where you're in control of your finances, to put it very, very crisply. And I think, there are two important terms. One is about financial well-being, which is in being in control of finances. The other is financial freedom, which is the goal that everybody really needs to work towards so that they can live life on their terms and be the master of their own time. So this is what it is.
Okay. So, the most important question is, suppose you're coming from a financial background, you happen to be working in a mutual fund industry, then you know the nuances of investment and people do go on about with their own. But it's sometimes very challenging for people in other professions, for housewives, for retired people. So what are the kind of key things one needs to keep in mind when it's coming to personal finance? And the more important point is, in India, even today, when it comes to investments, it's more about savings rather than investments. It's more about fixed deposits rather than actually mutual funds. So wealth creation is just about to start off. What are your views, and one should keep in mind all about?
Yes, so I think one of the very important factors is that people need to have a financial plan. And honestly, most people do not follow a structured financial plan. It's all about looking at investments that are doing well and investing in those. So when small caps were doing well, then you saw big, big inflows into small caps for the very fact that people tend to look at the recent performance and they tend to chase the recently well-performing instruments, either mutual funds or stocks or gold, whatever it might be, right? And what typically ends up happening then is that people really don't know when to exit, and you really don't know what to do if there is volatility, when the markets are up, when the markets are down. Also, another thing that I have seen in my financial wellness programs is that people are very, very unprepared for emergencies. And incidentally, we ran a survey in February of this year among working women professionals. And a majority, about 43% of women said that they had not thought about a situation in that how they will manage their health insurance in case of a job loss, right? So I think what is happening right now is that, there's this big enthusiasm in getting into equities. And there's a lot of interest in creating quick wealth, but the fundamentals that we need to have in place are actually not there, right? And the fundamentals really start off with, firstly, you know, uh, having a good amount of saving, right? Now, again, you'll pick up any survey today in India, it'll show you people are saving less than 20% of their take home, which is a very, very low number. So when you want to create wealth, you need to have a good base as well. It's not only about investing and trying to then grow it 100 times, right? So you need to start with a good base, which means that you need to have at least 30% of your take home going towards savings, right? And this savings needs to be invested as per a financial plan. But before you jump into all that, you need to have your financial security in place, which is in form of the emergency cash. And I know everybody talks about it, but again, it's like one of those things everybody tells you that you need to eat healthy, but you don't end up eating healthy,
Yeah.
right?
Yeah.
It's the same thing with emergency cash. Everybody knows that they need to have this emergency cash of 6 to 9 months of expenses, but they don't plan for it, right?
True.
And of course, I think in today's time, having the right amount of life and especially health insurance is very important. India is one of the most underinsured countries in the world. Even now, I meet people who have health insurance of 3 to 5 lakhs. In fact, I think the average is 3 lakhs. And I think that's a very, very low number given the health expenses today. And even if you get like a large illness, your cost is going to be anywhere between 15 and 20 lakhs. So
True.
at least 15 to 20 lakhs of cover is what a family of four needs today.
Yeah.
Of course, where investing is concerned, as I said, you need to begin with a financial plan and you need to be investing as per your financial goals.
Yeah. So the one interesting thing that happens is that people start, start their careers, their journeys, and somewhere initially it's all that euphoria about getting a job and they start spending. Savings is relatively the last thing on their mind. It's only in their 30s and the late 30s and early 40s sometimes when people start to invest in the true sense, because that's by then, they have realized. Have you come across such scenarios, where people have started to invest late in life, and what kind of advice would you give to such people?
Oh, I've come across this very, very often. Like for example, retirement. Most people start saving for retirement only in their 40s and 50s, and then they realize that the amount that they have to save is very high. In fact, I do sessions for people who are retiring to help them with their post-retirement planning, and it's very, very sad to see that for most people, they're not going to be able to meet their monthly expenses with the amount that they have planned, because what typically happens is that investors forget taking into account inflation, right? And even like I do a lot of TV shows and people say, I need to have 1 crore for retirement. Now, my question is, how is this 1 crore number? How have you come to this number? Because this number has to be based on your current expenses and it needs to be inflation adjusted, right? So I think that, one of the things that I would again get back to is saying that there are a lot of, for example, a lot of retirement planning, goal planning calculators, which are actually available online. So firstly, always check what is the, what is the amount that you need to invest and what is your end goal. Like, if you say my end goal is retirement, but how much do you need for that retirement? That's the end goal, not retirement, right? And then more importantly, where are you investing? Now, for all the noise that you have around equity investing and this retail investor who's investing, when you again look at data, it shows you that most people have less than 10% of their portfolio invested in equities. And 90% of the portfolio is invested in traditional investments, which are not very high yielding, right? So, given that, again, given the large goals that everybody has, because today what's happening is the value of the goal is large. On top of that, you have inflation, right? And hence your goal values are like really expanding. So which means either you can invest more or you can take slightly higher amount of risk, right? And what is in your hand is the second one, which is to take a higher amount of risk. So what I would say is that you need to be very, very aggressive with your investments, especially where long-term goals like retirement is concerned. People still only want to rely on that employee provident fund, and while it's a great instrument, it is not going to help you really meet your retirement goals, right? So you do need to have equity allocation in the portfolio. And again, instead of jumping right in and trying to figure out what stock to buy among the 5,000 plus listed stocks, a better way and an easier way for everybody is to just buy a plain index fund. And specifically for retirement, you also have the NPS, the National Pension Scheme. Within this, I highly recommend the active equity option. But, these would be my choices, like, investments which are managed, which are regulated, of course, highly transparent, and where you don't have to be actively involved yourself.
Absolutely. But when it comes to these kind of investments, people still go in for the very traditional fixed deposit route, right? A savings account, or even for that matter, recurring deposit. Of course, the idea is not to discourage them. This is important because end of the day, the money is immediately available. But when it comes to mutual funds, do you now see a trend, at least in the last few years, where there's an awareness at least building up and people are going in for mutual funds? Do you come across such people?
Yes. So I think the adoption of mutual funds has become better compared to even 5, 6 years back, where you still had to convince people to buy a mutual fund. Now that you don't have to do, right? But I think, again, where the problem lies is the fact that people don't know what to buy.
Mm.
And there's this whole big focus on direct versus regular plan, which honestly is unfounded, in the sense that your focus needs to be on the choice of the fund that you're making, because you're in it for the long term,
Yeah.
not really whether you're doing it on direct or a regular plan, right? And we get a lot of queries from people saying that I want to start SIP, but I don't know how to go about it. I don't know how to choose a fund. And the reality remains that making a fund choice is very, very difficult, right? I mean, investors don't even know what to look for, right?
Mm.
And hence they look at recent performance, right? But that's not what you need to look at, right? The other one thing that I'm also seeing is that there is this very high focus on newer products as well, right? So you have a lot of newer products that have come into the market which are offering high fixed returns, right? And again, people do tend to fall for these products. And I think, one of the very important things to look for whenever you're choosing an investment product is, firstly, is it regulated, right? Today, we have a lot of unregulated products, and the most common one being the jewelry scheme from the the
Yeah.
gold shops, basically.
Mm.
Second, of course, you need to look at what is the risk involved, right? In any investment that you do, can I lose principal? Can I get my money back if there's a problem? What sort of problem could be there? And then finally look at the returns. And I would also say that on mutual funds, anybody wanting to invest in funds, please tone down your return expectations to 10 to 12%. I get inquiries saying I need to make 18 to 20% out of my mutual fund. So, these are some of the things that people need to be cautious about.
Absolutely. I have a very specific question for the young professionals who are starting their careers, and most of students could probably, of course, the students may not have money in hand to invest. But having said that, today a lot of students do a lot of hustling, get into social media, and get that money out there. What would your advice be? Because it is indeed important, right? That the earlier you start to invest, you would have pots of gold, as they say, in years to come. What's your advice?
So certainly start early, but I think one trait that everybody needs to develop is the ability to remain invested. Because, like with everything in life these days, people also want their instant gratification from their investments, right?
Yeah.
And everybody wants their money to multiply many times in like a 2 year period, and I get these inquiries from people saying, I started a SIP 6 months back and now it's negative. So should I exit and move somewhere else? So the key to really building wealth is remaining invested, and I think that's one thing that everybody needs to think about
Yeah.
in a very big way. Unfortunately, I see that people are not thinking long term anymore. Everything is about the short term.
Yeah.
Nobody's really thinking about long term goals. So that's one thing the youngsters also need to work on. And again, have some amount of your portfolio, some amount of money kept aside for exciting investments if that gives you excitement,
Yeah.
but be ready to lose the principal. But I would say a larger part of your money that you have earned, should be invested in as simple as an index fund. Yes, the problem with the index funds is that it sounds very boring and
Yeah.
it's not exciting. It's not something that you can boast about to your friends,
Yeah.
but that's what will make you the money.
True, absolutely. One last question before I let you go, Mrin. Can you share about your own career, because you have been into a career where what I believe is women entrepreneurs in this space are relatively less. I'm sure your kind words will definitely encourage a lot of other women who would love to get into this space. And there is so much of talent, not just in tier one, but even tier two and three cities of India, and where there are women who could be interested in a career or pursuing a career for this, what would your suggestions be?
So I think wealth management and investment advisory is a great, great career choice. And like in my own journey, I was working with foreign banks. And then after that, From 2007, I started my own multifamily office, ran that for about 10 years. And parallelly, then I had started Finsafe about 9 years back. The reason I started Finsafe was because I saw that there was this huge gap in the financial literacy levels of the educated people in India, right? And I felt that, while there are a lot of platforms through what you can invest through, but there's no one who's actually telling you how to do things right. And it is a complicated field. Everybody feels they know everything about money management.
Yeah.
I can tell you more than 95% of investors actually do make all the wrong moves, right? That's why I started this company, and we basically work on financial wellness at corporates. But at the same time, one of the things that I am seeing that is that people want, especially at retail level where the access to financial advice is limited, right? Is a financial counseling sort of a model, right? Where you pay for an hour's time with the advisor, like how you meet a lawyer or a doctor, right? You pay fees and you talk to them for an hour and get your queries clarified or whatever it is that you want to get clarified. So I feel that now, over the traditional advisory models, things like this are also there in India, and such sort of models also can be successful. And I see a very big role for women in this space because one, let me also say this, that, most of the women that I meet, they actually want a woman advisor, right? So you have a very big segment out there itself. And it's a very good field because women do have more patience to basically answer questions. But what I really believe is that women also need to ensure that they, like, if we're talking about women advisors, you need to be constantly reading, you need to be constantly updated, you need to be constantly upskilling yourself. And the other thing is that women typically shy away from let me say customer facing sales roles, right? Or advisory roles, right? Women typically like to go in for these back office roles, but you have to believe in yourself that you can do it. And it's a really fun field to be in, honestly. And I always encourage all women, like whoever comes to me, I always encourage them that you can do a lot in this field. But yes, it takes time and you need to be committed, and it'll work in the long term.
But how does it one go for, are there any courses, any specific, educational background that they need to spend before they step into this world?
Yes, of course, you need certifications. So you have the NISM certifications, which is if you want to become a registered investment advisor, then you need to do the 10A and 10B. And otherwise, you need to pass the mutual fund distributor exam, which I think is 5A. So you do need to pass some of these, and you do need to have some basic qualifications as well. But I think, this is the certification part of it, that allows you to do business, right? But other than that, it's all about, upskilling, as I said, right? Keeping yourself aware of what's happening, and the ability to, again, the ability to understand what is happening and not see it only, like not read a report and just go by everything that's written in the report, right? So the ability to basically do that.
Interpreting also is important.
Yeah, that's right. Yeah.
Absolutely. Mrin Agarwal, thank you so much for being on this podcast, The Sound of Money. And thank you for sharing your amazing views. And I'm sure our listeners, our audience will definitely, take advantage and, do something, especially when it comes to careers, and hope to see a lot more women, entrepreneurs who go into this space of advising. Thank you once again.
Thank you.
And well, with that, we come to the end of this episode of podcast The Sound of Money with me, Santosh. From me, Santosh and Mrin, thank you once again for joining me. Bye and take care.